Morning, everybody. We appear to be a bit thin on the ground. I'm not quite sure why, but never mind. I think we should probably press ahead because there's plenty to get through this morning. So I'll be doing the news as normal, and then Andrew McHattie is going to look at what happened over the course of October, and then Richard Williams is going to be talking to this week's guest, who's Jason Bagley, the manager of Aberdeen Property Income. And obviously, that's quite interesting what's going on in that sector at the moment. So news first. So the three things that I picked out to have a look at were Atrato Onsite Energy, CQS Natural Resources Growth and Income, and Princess Private Equity. So Atrato first. This is really a relatively new fund. It's not even a year old yet. But as you can see, the share price has come off quite sharply over the course of the past month. And it's now trading at a small discount for the first time. And there's also been a bit of an NAV dip. And I'm going to explain the reasons for that now. So it raised £150 million. It says it was significantly, multiple times oversubscribed. I think the idea of addressing the kind of solar market through the rooftop area makes logical sense to most people. And so that's probably why it attracted so much attention. It said it was going to get that money invested within 12 months. And the reason that it capped it at 150 million was because it said that was the maximum it could deploy within 12 months. Fast forward to April, and it's still expected to be able to do that, but it was only sort of negotiating over about 24 million quid's worth of investments. And it paid a dividend. I'm really starting to come out firmly against this idea of paying dividends before you've got any earnings. I know that some people like doing it, so sort of attractive. I think it's really not a great idea. Obviously, that eats into NAV when you're not earning any money. Then they fired out a couple of announcements that they were making investments. So in June, they did an MS distribution centre. In July, they bought, they agreed to invest in a ground-mounted plant next to the Nissan motor plant. Ground-mounted, obviously, rather than rooftop, slight sort of, deviation of what they said they were going to do. But it's still the same sort of area because they are doing it on a private wire agreement. So basically Nissan is taking all the power behind the meter, so it never goes into the grid. And that is all sold on a pre-agreed price with Nissan for the foreseeable future. And that's the way most of these deals that Atrato is going to do are going to work. In September, they bought a portfolio of assets. So that gives them a little bit more exposure and agreed a new project with a 25-year purchase agreement rather. And then it started to sort of go wrong a little bit. So this Vale of Mowbray thing is really quite tiny, only 0.6% of the portfolio, but it just shows you that the dangers of doing these long-term PPAs is that you need the counterparty to be creditworthy. And in this case, the counterparty went bankrupt, it's come to administration. So they're still producing power, obviously, because that doesn't stop happening. And that power is being sold to the grid. And actually, they're getting more money for that power, selling it to the grid, than they would have done under the pre-existing power purchase agreement. So from that point of view, it doesn't really make an awful lot of difference, but it just sort of gives you a note of caution. And then this week, they said, well, our NAV is actually now 92.8p, down from 100 at launch. And the reason for that is because we've had to put the discount rate up on the few things that we have bought. So they're only about a third invested. And they've upped the discount rate to 6.6%. And we don't really actually know what it was beforehand, which is, but there we go. I'm sure that's in the small print somewhere. I couldn't find it. Anyway, that took 6.5p off the NAV. But going forward, they say, well, we're going to be doing all these deals based on this kind of discount rate. So the other 100 million that we've got to deploy will be going at that sort of rate. So we're still going to be able to earn the sorts of returns that we promised you at the beginning. So this is the reason that it's said why they're struggling to deploy the money. Basically, political instability, which is the reason for all sorts of things happening, I suppose. They've extended the timeline out until the second quarter of 2023, which could be anywhere up to the end of June, I guess. They do say that they are making some progress on this. So they've got a pipeline out there of about 100 million, which is almost ready to go. I would like to see them deploy that quite quickly. I think they now have to kind of rebuild confidence in the story, and that's going to take a little time. And I think getting fully invested and making sure the dividends are covered is going to be really quite core to that. So we shall watch this one with interest. CQS Natural Resources, I wanted to mention because actually these results are quite good. And actually you can see here that it's had really quite a good run over the last couple of years. And that's helped narrow the discount a bit, but it's still trading on a discount, and I'm not sure that it deserves to be on quite as wide a discount as it is. Here it is within that sector. Not huge, £134 million, but still a reasonable size. As I say, that discount I think is too wide, definitely relative to things like BlackRock Energy and BlackRock World Mining. It is supposed to be a growth and income fund, and it does offer a yield, but it's not as high as the other two. But I think that's because it's focusing as much on the growth as on the income. Ongoing charges are probably a bit too high, and that would be helped if it grew. So it's what I quite like to see the discount be eliminated and issuing shares. We'll see. Anyway, there's the returns in terms of what's been going on with the sector. Big dispersion of returns within here over the past year, but it's been doing quite well. The only funds that have been beating it are BlackRock Energy and Riverstone Energy, which obviously got a higher kind of oil weighting. But you look out kind of 5 years now, and the numbers are looking pretty good. It's well ahead of BlackRock World Mining, for instance. So I think that's important. It's a commodities including energy portfolio. And it's because it's got this income angle as well. It's the benchmark is based on a combination of mining index, which is EMIX Global Mining Index, and a bond index, the Credit Suisse High Yield Index. And it has done a pretty good job of beating that over the past 5 years, as you can see there. And it's paying out these dividends. They're not quite covered by earnings. I think that's unfortunate again. But that is rebuilding quite quickly. So there's a hole in the income last year that's been bouncing back quite fast. I would think that the dividends will probably be covered this year. We'll have to wait and see. Now, this is what the manager did that made all the difference this year. So it started off. Here's the portfolio in 2021, and you've got big exposures here to things like fixed interest and zinc and base metals. All of those things have gone. They're not in this paragraph over here. And what has greatly expanded is the weighting in oil and gas. And you've got this new segment in coal. So basically, there's been a big shift out of industrial type metals and into energy. And that is really worked for it. So I think that the core message here is that energy prices have just gone crazy, as we know. But within that, I hadn't appreciated quite how far coal had moved. So we know that OPEC's production cuts help rebound crude prices again, and that's helping that part of the portfolio. They're seeing a lot of drilling activity in the States in particular, as the wells are run down and kind of like shale type wells, and they need to keep drilling to maintain that output. Obviously, the gas prices have been very high, but the coal here up 250%. And the extent to which that feeds through into share prices is incredible. We should all bought this one. So basically, they paid £3 for it in 2021. They got that as a dividend, a quarterly dividend, just recently. And those shares are now £16, and they say that they're still on 20% yield. That's just crazy. Obviously, it won't last, but still, nevertheless, that's pretty impressive. The downside, obviously, is that they are quite negative about the economy going forward, and that means demand for industrial metals is going to be low, and so their switch out of those was very timely. Copper's dropped 25%, other base metals down too. The only thing that is still working is things like lithium, so stuff to support the new zero carbon economy, that's still in demand, and they've got a big whole position in this thing called Sigma Lithium, and that helped drive the returns. They're also hanging on to quite a big position in gold miners, because they do believe that inflation is here to stay. and we may even see proper stagflation. We'll have to wait and see. So this is not a bad, I think this is not a bad fund to be in this kind of environment. People keep asking me, what should I be buying now? What should I be holding now? I think it's really not a bad option. Anyway, Princess. Now, this is a sort of steady Eddie, but unspectacular private equity fund. It's just had a bit of a disaster, which we're going to explain now. And you see the share price has just collapsed, and there's a good reason for that. Here it is within its sector. So market cap of about £470 million, but now on a 45% discount, which is just crazy. There's about 9.5% yield. I don't know why that's in one decimal place, so no different places rather. The highest in its sector, but that's because it pays dividends out of capital. And that's been depressing its NAV returns, and as you can see down here, it ranks towards the bottom end of the sector in most time periods in terms of NAV and share price returns. It pays 5% of its NAV out each year in semi-annual dividend payments. So with an NAV of about €1 billion, that's about 50 million euros a year, which is a big chunk of cash to find. And what happened, the reason why the share price has dived, is it's just said we cannot afford to pay our second interim dividend. So about 25 million euros worth. The reason is quite bizarre, really. They've been hedging their currency exposure. So basically, this is a euro denominated fund. They do all their accounting in euros, and they've been hedging the dollars back into euros. So they've missed out on all of the gain in the dollar, and actually been left with big sort of hedging problems that they're having to sort of make margin payments. And that is hoovering up cash. So, and on the other thing that they've said, which is massively unhelpful to the sector, is they're saying that they're struggling to get disposals through because of the finance not being available in the debt market. Now, almost everybody else I've talked to says yes, that's at the margin that's an issue, but they're not really seeing it as a major problem. But they've just highlighted it. This is the reason we can't pay our dividend. So I think that's really going to not help the whole sector. They do reckon, though, that they've got enough liquidity to meet the commitments that they've got. So they've got some cash and they've got some senior loans that they can still sell in the portfolio. This was the position at the end of June. So they published their interim accounts really not very long ago. And then they had cash of about 17. They'd drawn down 42 million of an 80 million credit facility. They upped that credit facility from 80 to 110 on the 4th of July. I think that might have been a bit of a hint as to what was going on. But unfunded commitments there were about 103 million euros. Now, I keep stressing this because people say I've got commitments of this. That doesn't mean that's only going to come out in the next week, month, year. Those are spread out over a long time, and some of them are never called. And funds regularly run with overcommitted policies because they know that they want to keep the cash invested, and they know that the stuff is going to flow back. And if it doesn't flow back, then you've got a credit facility to use to dip into if you need it. What Princess has done is it's been using its credit facility to do this hedging stuff rather than to make it available to fund the portfolio commitments. So, but the really annoying thing, and what's really upset investors, is that they didn't give any hint of the problem going on, even when they did this interim announcement. So they said, we're getting money coming out. The money will be redeployed in direct private equity investments. That's not what they were doing. They were using it for the hedging. At the time, they still had 72 million left in senior loans. Obviously, they've been selling those down since. And they don't really talk about the hedging anywhere in their annual accounts or in the interim accounts, except in the small print, in the notes, in the proper, back of the annual report. Note 11 actually lays out the foreign exchange contracts that they had, with no comment about what they're trying to achieve or the potential risk of that. So this is positioned at the end of September. They had negative net current assets of about 100 million. They only had 9 million left on that credit facility, so they've drawn down more than 100 million of it now. but they haven't been using that for commitments because they've only dropped by 250,000 euros. So all that money's been going for the hedging activity. They're not going to scrap the hedging activity. They're going to suspend the dividend instead. Again, people just think that's mad. They'll be talking to investors on the 22nd of November. I think they've got a lot of questions to ask. Anyway, that's all me. I'm now going to hand over to Andrew.
Great, thank you very much, James. And there's a lot of interesting stuff there. I'm just going to switch over my screen. There we go. And yeah, it's particularly interesting about Princess Private Equity, I think, that a lot of these quirks and wrinkles in investment trusts go unnoticed during good times for the market, and now that there's a bit of a squeeze on liquidity, they're coming out. And we have seen as well, the necessity to read the fine detail of all of the discount control mechanisms as well, because some of those are starting to cause problems for trusts like Starwood European Real Estate, which decided to wind up. Anyway, there'll be plenty more of that discussion to come, I'm sure. So let's have a look at what's been moving in October. The gains over the month were reasonable, and the sector was up marginally over the month. In spite of all of the macro noise and political noise, actually it wasn't a bad month overall for investment trusts. So a reasonable smattering of gains, actually across a number of sectors, I think, and there's no great unifying theme here. Some interesting bounces in things like warehouse REIT and alternative income REIT, and some of the UK smaller company trusts like Montanaro UK smaller companies. But I'm going to just talk about a couple of the UK mid-cap trusts that are on this list that had a decent month, rising by about 11% or so. I think actually the fallers are probably a bit more interesting at the moment. The figures are slightly higher here. So in spite of the overall decent returns in October, there was still some shakeouts occurring. Schiehallion Fund has been on this list so many times in recent months, and I'm just going to talk about that briefly. I think that might be settling down finally. And there are 4 China trusts on this list of fallers, so I'll talk about those, and also Baker Steel Resources. So plenty to talk about. I'll start with the UK mid-caps. And I think the really big point to make here, which I think is reasonably well understood, but nevertheless quite shocking in the quantum, is just how much the mid-caps have underperformed against the large caps over the last year. The difference is really huge, because if you do look at the FTSE 100 index, it's really not bad at all. It's only down 1% over the last year. But the domestic stocks have fallen by so much more. I mean, 22.8% for the FTSE 250 index. And I think it's very easy to explain this, really, that there's a few factors that have been maintaining the value of the large caps. I mean, partly it's just that investors want to be in the largest stocks when they're worried about sustainability of earnings and dividends. It's partly that mid-caps are more domestically oriented. And really, I think one of the really big factors is that the large caps have been supported by the falling pound. They're mainly international companies with international operations, and the falling pound has been a big support to their earnings. The other thing is that the sector makeup in the FTSE 100 index, again, just is relatively supportive in this environment. So you have a lot of materials. When I see that Rio Tinto is up 6% today, that hasn't got much to do with the UK economy, but it's in the FTSE 100. And there's a fair bit of energy, healthcare, and not very much in communications, technology, and real estate, which are sectors that have all suffered a bit more. So I think it's easy to see why the large caps have performed so much better. Where they go from here is another question. but I think there is a bit more scope probably for the mid caps to bounce, and the same applies to small caps, of course. So if you do feel that we might get a fourth quarter rally in the markets, then mid caps may be a place to look rather than the large caps. Supporting that, I think, are the ratings on these trusts. I've highlighted here the discounts on the three mid-cap trusts here, which are all double-digit discounts. And if you compare that to some of the large-cap trusts or the big international trusts, those tend to be on single-digit discounts, so there's a bit more value here. And that's completely normal, of course, but nevertheless, I think it does, again, indicate there's a bit more scope for a bounce here if you are feeling optimistic, and that's a big if. So let's turn to some of the things that were going down this month. The Schiehallion Fund has been quite a fascinating one for some time. This is a slightly longer term chart here, just 3 years, I think, and it just shows that the considerable rise and fall. It looks very much like a mountain range, as befits the ticker code. But the real point is that you've seen this very large premium to NAV for quite a substantial part of this period that has been impossible to sustain. And this has been a funny trust because it's very tightly held. I think that there hasn't been very much selling from fairly dedicated holders of the trust. So it's taken a while for it to come down, but it has now finally declined quite substantially and fallen to a discount. Quite a chunky one, actually. I mean, it's 35% on the C shares and 26% on the ordinaries. It's very hard to say, of course, whether that is, you know, a sufficient decline, and also the NAVs, of course, can't necessarily be relied upon at this time. It depends when they were last valued and so forth. But it doesn't look really out of line with other trusts in the growth capital sector now. And I can see that perhaps this one deserves a small advantage over some of the others here. So, you know, I think possibly much of the decline has come to pass now. So we might not see this trust on the list of fallers every month in the future. This month, the 4 China trusts all fell quite sharply. And if we look at their 6-month returns in this table here, they're all pretty awful. Aberdeen China's held up a little better, down 14%. The other 3 are all down about 23%. It's clearly been a very, very rough period for China. There's so much of that has been politically driven, I think. Certainly all of the comments I read about the third term for the leader was quite negative for the stock market, because it was seen really as a blow for liberalism. And I think as well that his focus is much more on security rather than the growth of the economy. And therefore it was seen as a very negative thing by investors, I think. At the same time, we've got this zero COVID policy, which has just been so troubling because it keeps interrupting economic activity. And of course, this is very newsworthy indeed. You probably saw some scenes from the Shanghai Disneyland last week, where, you know, huge numbers of people were locked in because they had to demonstrate several days actually of negative COVID tests before they would be allowed out. This is all pretty bad for the optics, but also quite seriously for economic production. And I was reading this week about some interruption to the production of the Apple iPhone. So, you know, it is quite significant. And my sense is that investors are really looking for a bit more certainty here. And one thing that would make a very big difference is if China did end its zero COVID policy. But I think with the current leadership in place, there's no way of knowing. And that's the difficulty for investors, that you might have an opinion on this, you might be able to take a view, but I really don't know what strength that has, because I don't know what insight you can gain into the leadership. Last night, there was a big rally, actually, in Chinese stocks, because there were hopes of China reopening the border with Hong Kong and potentially easing its policies at the start of the new year. But I'm really unsure about that. I think you've got to be quite brave, actually, to invest into China at the moment. Single country trusts are always a bit of a speculative bet, I think. And right now, I mean, you may look very clever in a year or two if you invest, but I suspect that for most investors, they're going to want a bit more concrete information and a bit more certainty first. So it looks quite speculative to me. On the subject of things speculative, actually, Baker Steel Resources Trust, obviously in the same sector as CQS Natural Resources, which you were talking about, James, it's quite an interesting one, I think. If you look at the track record, it's not very good. You know, the 5-year numbers and the 1-year numbers are both pretty poor, actually. And it is, in its very nature, quite speculative. It's taking stakes in small mining projects. So I don't think it's sensible, really, to think of it so much as a natural resources trust and to bracket it with things like BlackRock World Mining. It's more, I think, a private equity trust that happens to be focused on that sector. It does have a mix of listed investments and unlisted. It's 47% unlisted, so quite substantially so. And actually recently, where a couple of its holdings did IPO on the London market, that looked like really good news initially. But the subsequent share price performance of Tungsten West and First Tin has been truly appalling. I mean, if you want to feel better about your own portfolio, have a look at those, and you'll see that they've done much worse. So on the one hand, it seems quite good to be able to achieve some value by your holdings coming to the market. Actually, that hasn't worked out well for Baker Steel because, of course, they have a lock-in agreement and haven't sold out. Not that they want to. But I think the interesting point about this one, and the reason I think why it does merit some investigation now, is that its largest holding is in a company called Futura Resources, which is unlisted. It's 27% of assets, so it's a really chunky holding for them. And the news here is that Futura is said to be very close to a finance deal, which will bring its coking coal assets into production. And that deal is expected to close by the end of this calendar year, which will bring the assets into production probably by April of next year. And you mentioned, James, that coal prices have been extremely strong of late, actually. I mean, it's a very good market to be in spite of ESG concerns. And I think the information here about the finance deal being close is very good because Trevor Steele, who is one of the co-managers of this trust, is on the board of Futura, so he definitely knows what's going on there. If the financing deal does come to pass, then the valuation of the asset should change because it will change from being a development asset to a production asset, and therefore at a much higher valuation. So we could see a significant uplift, and already the shares here are on such a big discount that there's potential there, I think, for a good share price rally. So the discount at the moment is 42%. There hasn't been very much demand for this. That's partly because it is very small. it's only a £50 million trust, so far too small and illiquid for many investors. But if you're quite a small investor and you're seeking to put in relatively modest amounts, then I think that's quite a complementary holding to some other holdings you might have in the commodity sector. So there we are. That's just an idea to wrestle with, and I think that's it for me. I'll hand you back to James.
Actually, we're going to go over to Richard, but while Richard takes over, there's a couple of questions there. Have you been buying anything in the dip, Andrew?
Well, I have been buying things in the dip. I think at the moment there's so much tremendous opportunity in this investment trust market. There's a lot of great valuations and some very tempting yield opportunities in particular. Yeah, there's a great deal of competition, I think, for your money. I wouldn't necessarily put too much more into the UK at the moment, but I think all right across the board, there's so many good things to buy.
Cool. We better let Richard take over and talk to Jason. And there's a couple of questions for you. If you don't mind sort of typing an answer in, that'd be helpful.
I will, of course.
Thank you.
Thanks.
Right, over to you, Richard.